Good evening. Thanks for tuning in. You're watching The Urban Debate with me, Avni Raja. Amid rising prices, there seems to be no relief from high inflation just as yet. RBI has said that inflation has eased slightly, but still expected to remain above the tolerance level for at least 2 more quarters. Keeping the inflation battle in mind, in today's credit policy announcement, Reserve Bank of India has hiked the key lending rates, the repo rate, by 50 basis points to 5.4%, taking the policy rate back to late 2019, that is the pre-pandemic levels. What was also important to note is RBI's tone, which clearly meant that more rate hikes cannot be ruled out going forward. The central bank projects retail inflation about 6.7% for the year, easing below 6% only after December. Meanwhile, the GDP forecast has been retained at 7.2% for FY23. What was also stressed on by the governor was the part as far as inflation is concerned. Governor said that inflation has eased from the April surge, but it still remains uncomfortably high, above the upper threshold, and that it is expected to remain above 6% in Q2 and Q3 as well. He also pointed out that sustained high inflation can destabilize growth in the medium term. RBI Governor Shaktikanta Das also noted that the Indian economy has been impacted by global events. He has said, however, that there is not going to be any impact on developments happening in Taiwan. But tonight, I'm joined by an expert panel to break all of this down, the RBI policy, what the governor has said, and what it boils down to when it comes to inflation. When actually are we going to see inflation come down? Let me welcome our guests who are joining us on the show tonight. But before that, let me quickly take you through what the RBI governor has said. Listen in.
The MPC decided unanimously to increase the policy repo rate by 50 basis points, 50 basis points to 5.4% with immediate effect. Consequently, the standing deposit facility, that is SDF rate, stands adjusted to 5.15%. Consumer price inflation has eased from its surge in April, but remains uncomfortably high and above the upper threshold of the target, that is 6%. Inflationary pressures are broad-based and core inflation remains at elevated levels. On the assumption of a normal monsoon in 2022 and average crude oil price, that is Indian basket, of $105 per barrel, inflation is projected at 6.7% in 2022-23, that is the current year, with Q2 at 7.1%, Q3 at 6.4%, and Q4 at 5.8%, with risks evenly balanced. CPI inflation for the first quarter of next financial year 2023-24 is projected at 5%.
And let's welcome our guests who are joining me this evening. Swaminathan Aiyar, Senior Economist, Amir Khan, Economic Policy Expert, and Dr Brinda Jagirdar, Senior Economist as well. Thank you so much, all of you, for joining us today. Let me start with you, Mr. Aiyar. You know, of course, the 50 basis points was something that was widely expected, but the tone of the RBI governor, did that come as somewhat of a surprise, given that now clearly more rate hikes cannot be ruled out?
And one of the problems that the governor has to face is that while there is some kind of pretense that a central bank governor can control inflation, the truth is these are being controlled by enormous, huge global things, which are absolutely beyond our control. The inflation in India has not happened because the governor was sleeping. It happened because there were huge global things that happened in terms of shortages, and in terms of what happened in supply side and demand side things abroad. That is not going to disappear. I think the main thing that the governor can do is to ensure that our exchange rate is not seriously affected. if you get a situation where the Indian interest rates are out of kilter with the other global rates, then you can see a huge flow of dollars out of India. So I think the most important thing that the governor can do in adjusting the inflation rate actually is to ensure that you don't get a taper tantrum, you don't get a huge flow out. Beyond that, the future of inflation is not going to be decided by an increase or decrease of 25 or 50 basis points. It is going to be decided by the global events ahead. And it is true that, commodity prices have been coming down, which is a plus point. Russia has offered some kind of potential ceasefire. If that comes about, things will look up. On the other hand, there are other people. The governor of the Bank of England is already predicting a long, long British recession going to the end of 2023. If you get a repeat of this, then you're going to get a very serious global demand issue over and above supply disruptions, in which case inflation will remain a problem and recession will remain a problem.
All right, Dr. Jagirdar, coming to you here, what is your view on this? Because this has been a big bone of contention about RBI hiking rates this aggressively, and how much is it actually going to impact inflation? Because at the end of the day, RBI is limited in the impact it can create.
Absolutely right, Avni, that but this inflation, now first of all, a 50 basis point increase was actually expected, and that is very much on expected lines. What really surprised me a little bit was that the withdrawal of accommodation, that still continues. I thought it would move straight away to normal, because if he's going to be on the hiking path, then it would, the first thing would be to come into normal stance and then start increasing the rates. But I'm surprised he didn't do that. But mainly, what we are seeing today happening in the economy, Indian economy, is due to global developments. Yes, inflation is not because of any shortages in India, but it is because of the serious supply chain disruptions, so which have affected the economy. And then, of course, global commodity prices, rise in fuel, rise in food prices. Luckily, India is self-sufficient in food, so that is, we're not impacted to that extent. But it's oil that we are heavily dependent on, oil and fertilizer, which have had serious impact on inflation. Having said this, globally inflation is now, I think, the biggest problem, mainly in the US and the UK, of course, which both the countries have gone into technical recession for sure, which has not happened with India. More than 50 countries in the world have raised their interest rates by more than 50 basis points. So this is a situation which is happening globally, and I think we should be prepared to deal with it. And we can't say that our inflation is okay, our growth is okay, and we can't do anything, we won't do anything. Having said this, I think the positive thing that comes that the governor said today was on the external front. So we are comfortable. There are many countries which are, in fact, IMF and the World Bank have brought out a study saying that about 69 to 70 countries face debt problems. They would default on debt because of high debt, forex inflows falling, forex inflows going out, their reserves falling. India, fortunately, is not in that kind of a position, and he said he took some pains to explain this. And we have reserves of more than 580 billion, which covers more than 10 months of exports. And and right now, FDI is stable. FPI has foreign portfolio inflows have also started coming in. And rupee has weakened mainly because the dollar has strengthened. Look at the other reserve currencies which have performed much worse than India, the rupee. So I think there's a lot of comfort that the governor has drawn, and he has indicated that while inflation is going to remain above the RBI's comfort zone of 6%, we are going to see by Q4, we are going to see inflation coming down to 5.8% and Q1 by 5%. So I think we have seen the peak in inflation, and from here on, of course, there would be some increase in interest rates, but I think the peak would stop at about 5.8%. And so we will not see such aggressive rate hikes going forward. But there's a little bit more to come. That's all I would say for now.
All right. Mr. Khan, your perspective on what we've seen today and what we can expect going forward.
Thanks, Avni. And, given that both Swaminathan Aiyar and Dr. Jagirdar have very clearly and very simply spelled out the factors, the external factors and the interest rate factors, also the exchange rate. I mean, really, that part of it is so very well explained, and thanks to both of them. I would just like to point out the issue on the other side. You see, what is worrisome and what is certainly not going to be addressed by what the Reserve Bank governor does is the problem on the consumption front. See, our consumption has been 65% of GDP for a long time. But what we are seeing over the last 6 or 7 years is actually a real fall in consumption as far as construction workers are concerned, and a tapering off as far as non-agricultural labor is concerned. In response to this, ironically, the outlay on Manrega has actually been coming down, and the big problem is, and a very strange problem, is that over the last few years, over the last 10 years, you find that our net sown area has actually come down from about 141 million hectares to 139 million hectares, which means that there is a serious issue as far as agriculture production is concerned. We still have 50% of our net sown area dependent on rainfall, and the impact of excessive rain or deficient rain does have a huge fallout on prices. The big elephant in the room that we are not addressing is this fall in productivity because of factors that are historical, factors that have a lot to do with reforms not being carried out in agriculture, but even more importantly is our rather lackadaisical attitude on climate change. The issue of the mango crop this year, the wheat crop this year should tell us alarmingly what happens if we do not address this issue as far as the supply side is concerned. And that is why, as Swami pointed out so well, that this is not happening because the RBI is not been doing anything. And therefore, this tightening of monetary policy at this point in time, it looks very unlikely to be effective because that is not the core of the problem.
Yes, absolutely. In fact, Mr. Aiyar, taking that point forward that Mr. Khan was mentioning, and your point as well, since you say that this is not perhaps going to have that kind of an effect as desired on inflation, what then are we talking about with respect to demand? Because demand was completely battered during the pandemic. It had just started coming back. And now, once again, we are going to see a complete clampdown, especially if there are more rate hikes. What then happens to that entire consumption story and demand?
Let us see. There are huge uncertainties. We find that Citibank predicted that the price of oil may come down to $65 a barrel by the end of the year and $45 per barrel by end of next year. At the same time, JP Chase said it might go all the way up to $375 per barrel. So when both of these are plausible scenarios, you understand that it is very difficult to say, what exactly is the situation going to be. As far as the demand situation, okay, the monsoon part of it looks okay. I think the real thing that will happen is if imported inflation, if the price of oil becomes very, very high, this will affect total purchasing power. Secondly, if we see recessionary conditions deepening in UK, in Europe, in the USA, that will affect our export demand. And export demand is a very important part of total demand as far as we are concerned. So there is a serious demand problem possibly coming up. I am not sure which way it will play. If the Ukraine war ends, all can be hunky-dory and suddenly there'll be a glowing boom of every kind that you can think. But if it gets worse, and if we have the central banks the world over clamping down, in effect creating a recession, we are not going to be immune from it. Global demand is going to come and it will create there will be a supply side problem. To some extent, it may be good for inflation, but it will be very bad in terms of the growth of the economy. And to that extent, when the Reserve Bank is trying to tackle employment as well as prices, there is going to be a problem. So I said, I will make no firm predictions on which way the price of oil and other things are going to go. But there are a great many hazards ahead. If all goes well, you can say the worst of inflation is behind us, if all goes well. It is also possible that the worst is ahead of us.
Yes, absolutely. And since you mentioned that it is possible the worst is ahead of us, if we see another big geopolitical, event taking place, recession, for example, of course, it's all very well. Our government has said that India has a 0% chance of going into recession. Our economy may be resilient, but for how long and how prepared are we, in fact, to handle any kind of another shock at that point, Mr. Aiyar?
I would say that we are not well handled. We are not well positioned to do the classic thing of having a fiscal boost to take care of a recession. I mean, our starting point is that fiscal deficit last year was already 6.9% of GDP. Please remember, if you go back to the Great Recession of 2008-9, Mr. Pranab Mukherjee increased the fiscal deficit from 2.5 to 6.9, which was supposed to be the most highest thing you could imagine. Right now, it is now the starting point. From 6.9, can we really afford to take it up to 7, 8, 9, 10%? I would say absolutely no. If you try that kind of thing, it will be seen as a form of gross mismanagement. Dollars will flow out of India, and you will have a very serious problem on that particular front. So I would say that at this point of time, if you get this recession coming in, we will face this tricky problem of what is it that we are trying to solve? Are we trying to go ahead with the economic growth, or are we going to be worried as to what happens to the stability of the economy and the balance of payments? I would go for stability rather than growth. Till now, Sitaramaiah and Shakuntala Das, both of them, I think, have been saying we are going to go for growth at some risk of stability. I think we would have to reverse that position and say, let us be fiscally conservative and not go all out. If we find that there is a recession coming, the classic counter-cyclical thing of increase the fiscal deficit by a large thing, I think that would be very dangerous.
Dr. Jagirdar, your comments here, because, like I was saying, the finance minister came out and categorically said 0% chance of India going to recession. But is that a fair assumption to really make? Can India be shielded, and for how long?
No, we've already faced two black swan events, the pandemic and the Ukraine-Russia war. If another black swan event comes before us, it will be very difficult to really manage. Now, there is very little space left also on the fiscal policy side. So we've run out of options on that front, as Swami just explained. And we have also very little space left on the monetary policy side with the global tightening, synchronized tightening by central banks and a synchronized global slowdown. So we really have very option on that. So I think the only option here is increasing in productivity and reforms, continuing with reforms. Now, productivity is not something which is something new. We've been talking about it for a while, but not much action has happened. I think this is time now to raise productivity, whether it's in the farm sector, whether it's the manufacturing sector, use capital more efficiently. Having said this, I think there is, right now, India is, if we see a global recession, for example, we are already talking about, it's not a question of if, I think I should say when. So the prices of commodities will have already started coming down, and that probably should give us some kind of relief. So on that front, we would be, I wouldn't say shielded, but I'll say we have some cushion on that front. And where domestic growth is concerned, domestic growth, whether it's high frequency indicators or long-term indicators, I think domestic growth is doing very well. And with the capacity utilization in manufacturing sector going above the long-run average, as the governor pointed out today. So we have, and the banks are now in a position to lend. Banks have cleaned up the balance sheets, they're well capitalized, the asset position is good. So banks can support this growth, and manufacturing sector has deleveraged, and they're also in a position to borrow, and capex can because they are now the capacity utilization has gone so much, so they are also ready to invest. So I think from a growth perspective, I think India is much better placed than any other country. And the zero recession is not just what India is saying. I think this is what the IMF has also said. So we are right now in a comfortable position. So we should see how we can protect our position here and protect growth at the same time, make sure that we don't import inflation.
Absolutely. Mr. Khan, the other big issue also that was mentioned by the RBI governor was with regard to the outflows that we've seen from India. Well, I think $27 billion is what he mentioned, the foreign outflows this year. Yes, domestic flows have been quite strong, but do you think that we might see that kind of the flows coming back? It has started, but coming back with the same kind of vigor that they exited?
It's tough to say because as we've been discussing, there's just too many external factors, too many and variables beyond our control. But yes, given the fact that our growth seems to be creeping back, that there is a lot of demand that is unsatisfied, and the fact that there seems to be enough recovery post-COVID, there is no reason why the flows shouldn't be reversed. The problem really is something that we are kind of ignoring, and that is it is the big grandstanding that is coming back to hurt us. The issues of jobs, for example. See, the discussion, and I think what worries the government a little bit is the fact that there is a lot of discussion around joblessness, which has been historically very high. The nominal decrease that you see, that the graph that you just showed shows, is just relative to the huge amount of unemployment that we saw last year. We still are struggling to find jobs, and that I think is something that gets hurt with what happened today again. This downward slide in unemployment will again creep up. The issue, therefore, is that we have taken, we've been very acting with a great deal of bravado on promising jobs, which we haven't been able to deliver, promising very, very strong rupee, which obviously was never in our hands. And therefore, that political messaging that was made is coming back to haunt us. And therefore, a lot of the discussion and the decisions that are being made now are based on the fact that we indeed are on the back foot domestically on the kind of claims that were made 4 and 5 years ago. And the hurt that the economy was suffered because of both demonetization and the continuing problems with GST are also evident. I say continuing problems, and that has to do with the specific question you asked, is that this constant tinkering with GST rates is not going to send out a good signal to foreign inflows. What we seem to be doing is every now and then, and with such amazing regularity, changing GST rates rather arbitrarily, and that sends out a difficult signal. That is why we are vulnerable on the domestic front.
Yes, absolutely. And I completely agree with you on the GST point as well. But Mr. Aiyar, the issue of jobs, that was going to be something that I wanted to touch upon with each of you. Where do you see that? Because obviously there have been a lot of promises made, as we just heard Mr. Khan also explain, but none of that has been lived up to. There is still a lot of unemployment, youth unemployment as well. And those issues somehow are just getting lost in everything else that's going on.
The unemployment, I would say, has been the biggest failure of the Modi regime for 7 years. They came saying that, we are going to provide jobs for all. There was this huge enthusiasm with which they got the votes. To me, the astonishing thing is that there is still so much backing for Mr. Modi, despite his very serious failure on this front. Having said that, the question is, how much more can he do? One of the problems that you have seen is this great fall in female participation.
Yeah.
And this has, people have debated it threadbare, and yet you don't get, to my mind, any good analysis of what is the solution. It's all very well to say India is looking very bad and, Saudi Arabia is now better than us on female labor participation. But there is no one India. In Himachal Pradesh, female participation rate is 55%. In Bihar, it is 6% in the same country. So, I mean, it would appear that there are deep sociological issues on in what states, in what milieus is it permissible for women to come out? In what places is it regarded that it is a bad thing for women to come out? Where is it dangerous for women to come out? So many of these social attitudes, the question then becomes, how do we convert Biharis into Himachalis? And that cannot be done by Mr. Modi or Shaktikant Das or anybody. This kind of social engineering that is required is a very deep point. Beyond that, the fact is that if you see modern technology, it is getting more, two things are happening. One, that's less and less labor intensive. Mechanization is rising at an extremely fast rate. Secondly, while the government is attempting to push manufacturing in various ways, the share of manufacturing in GDP is falling the world over. The idea that you will be able to buck that trend, I don't think it's going to happen. The fact is that we missed the bus on manufacturing. We should have hopped onto that cheap manufacturing bus back in the 1960s and 70s when Korea and others were doing it. And today it is almost too late. I would also say that despite some attempts at labor reform, the fact is that the moment somebody goes from the informal sector to the formal sector, suddenly there's a payment of 12% from his own, 12% provident from his account, another 12% from that state, then there's ESI, there's a pension fund, there are various. I mean, Manish Sabarwal has calculated that 42% of the cost of the employee suddenly goes up. So nobody wants to push people from the informal sector into the formal sector because there is such a huge jump. Beyond that, people are very afraid of tackling large labor forces. I know people who have 1,000 workers and they are trying to get them down. Whereas in Bangladesh or China, there are workforces of 20,000 and 150,000. Where in India do you get a workforce of 100,000? Only in services. I mean, if you will go to Infosys or you go to Wipro, even if you go to Accenture, a company like Accenture says that of 800,000, 700,000 employees globally, 300,000 are in India. So in the services sector, including multinational investment, I find that jobs are coming up. And yet the government's entire emphasis on manufacturing, I think that they are barking up the wrong tree and they need to change direction. But beyond that, I agree that we have a problem that mechanization is not creating enough jobs. Secondly, our quality of education is so third rate that we are creating millions and millions of unemployable graduates. And that problem, again, cannot be tackled in the short run. It requires an overhaul of the educational system to have excellence in schools and excellence in colleges. And that is at least a 20-year job.
Yes, absolutely. And interesting that you mentioned that difference between Himachal and Bihar. It just sort of highlights how the need is to look at each state individually. And that is just one issue. There are a multitude of issues where each state sort of needs to be looked at differently and sort of the situation needs to be handled. But I'll come back to that, Dr. Jagirdar. If you could also weigh in on this issue of jobs, because at the fundamentally, it all boils down to jobs. It all boils down to, how that is going to and how employed the youth are.
That's true. We are not able to create jobs fast enough, and we are not able to move people away from the agriculture sector, which has excess employment, into other sectors. That is very true. But having said that, India, this problem of unemployment is not something which has cropped up in the last 7-8 years. India has traditionally had about 6 to 7% unemployment always, and that's where we are at now also. What I think is the nature of manufacturing has changed now. We cannot go back to the China or the Korea model. That is not something which is, that option is not available now. Manufacturing has become very capital intensive. Look at the auto companies, for example. You'll find them, there are hardly any laborers there. The new companies which are being set up here. So therefore, but at the same time, there are opportunities coming up. I think our system of capturing the jobs is probably not getting reflected in what is happening on the ground. Right now, companies are finding it very difficult to get people, especially in whether it's finance or IT. These are two very, very hot sectors, and companies are not finding people. People come, take their offer letter, and then go back. They probably go take another job, go to another company, or they go back to their own company and get a raise. So it's not as if there's nothing happening in India. It is happening, but probably it's not, the mismatch is so much, as Swami just mentioned, it's education. Not just education, the skills also. We don't have employable people. So we need to quickly, we don't have a 20-year time frame, the luxury of a 20-year time frame. We need to quickly skill up people and put them in the places where they are required. So I think that can be done in the short run. At the same time, there are so many new jobs, like for example, in the entertainment sector, in the services sector, a whole lot of opportunities exist. I know people who have resigned corporate jobs and become influencers on the social media. So, I don't know how that is definitely not getting captured in our collection of data. So there are a lot of new opportunities coming up which we need to take in, look at them and understand them. And yes, of course, we have to skill people and put them in the right places. At the same time, we don't have, like I said, the luxury of waiting for 20 years. We'll have to do it quickly. The focus on MSME perhaps is a little too much, because the incentive to grow is not there. In China, a textile unit would probably have about 500 people. That would be the average textile unit size, or even in Bangladesh or Vietnam. But in India, not more than 50 people. So we are not able to get the economies of scale and economies of scope. And so somewhere, I think these issues need to be looked at. But for that, a closer look at the labor situation, labor reform, labor laws would need to happen before we can really say that the problem of unemployment is under control.
Okay. Mr. Khan, where do you weigh in on this? I mean, in terms of one part, of course, to what Dr. Jagirdar was talking about, the MSME sector, and the other part, a lot of these issues, these discussions become about, long-term solutions, which, of course, are going to take a lot of time. But at the end of the day, we are in the here and now and facing a situation that's so volatile, it could change tomorrow, next week, or next month. How does, and this government is in an extremely precarious situation. How does one deal with that?
So I just underline and highlight what both of them have already said. The horrible state of education in the country, and the lip service, and the complete lip service to skilling. Over the last 8 years, we just completely dumped skilling. And therefore, the long-term solution is in a bad shape. The short-term solution doesn't have any money or resources. What I would like to add here is something that Swami alluded to, and that is, what is happening, and what Dr. Jagirdar also said, that why are we not getting enough people? Where there are jobs, you don't have enough applicants. And yet there are millions of educated and uneducated youth in our smaller cities and villages waiting for jobs. See, one of the things that we are missing out on is that we have become a very hostile country, especially urban India. How would you move to a Bangalore? Bangalore, which 20 years ago was a welcoming city where the roads were paved with gold, as Dick Whittington would have said. Today, one would be wary of moving to a Bangalore or to a Mumbai, to a Delhi, and therefore, where the jobs are, you find a hostility to someone from another state. Forget about another country. And that is a major reason that we are not looking at. We have to make our cities hospitable. We have to make them safe. I mean, forget about the women. Men are not moving into cities anymore, and you find people moving from villages to other villages or to smaller towns, and very little of interstate migration. The COVID, that parade of poor, hapless people walking back home was such a big lesson for all of us, but we haven't learned much from that. So there are jobs, certainly not in manufacturing. There are jobs in the service sector where we need higher skills and higher education, which we don't have. But these people who will provide applicants for these jobs are loath to move, and that is something that we need to correct very quickly. A law and order and a security situation that needs to be made helpful and welcoming.
Yes, absolutely. I'm running out of time, but Mr. Aiyar, what then?
Avni, I'd just like to add here.
Yes, please go ahead.
Just quickly,
yes.
that that the people who went now work from home option is being given. So a lot of people want to stay in smaller places, or they don't want to come back to the big cities. That is one reason. And also, I think a lot of people have started coming back. I know people, companies which have flown their employees back into the big cities. So it's not, I would not agree that there's hostility or anything like that. I think the free movement is happening, and we need to acknowledge that.
Okay, fair enough. Fair enough. Mr. Aiyar, my question to you was, of course, like we've talked about various long-term solutions here, but right now, since you've also pointed out that RBI rate hikes aggressively is not really going to be, the key to sort of bringing inflation down, and at the same time, the government doesn't have much room on the fiscal side either. So what should then be, what is the solution really?
No, the idea that there is an easy solution to every problem is an illusion.
Yes.
When the problems are the most difficult, the solutions are also the most difficult. So all I can say is that it is possible that suddenly the global situation improves for the better. And if it improves for the better, then you can focus on riding on that wave of things going right. If things are going wrong, you just have to gird your loins and sit out this typhoon that could come in a worst case scenario. There are no quick, easy solutions. Wait and watch, be flexible, don't be committed to any one policy because you never know how things are going to change. So as I said, we are in a reasonably good position to ride out a storm, but prepare for the storm and be clear that you need to be flexible. Above all, do not go overboard on growth. If you find that stability is in danger, stability is more important than growth. I think that is the cautionary lesson for the next 6 months.
Well, absolutely. Hope for the best and prepare for the worst, I think, is what your comments lead out to. But yes. I'd like to thank all of you for joining me on the show and breaking this down at this point in time.